Good day, everyone, and thank you for joining us. This is Jason Lisui, and I'm joined by our CEO, Jeremy Fair, and Portfolio Manager, Paul Vendrinsky. Happy New Year to everyone, first and foremost. This is our first webinar for 2021, and we wanted to take this opportunity not only to take a look back at 2020, but also to look forward and look ahead to 2021. So the agenda for today is threefold. First, I'll discuss the year of the bailout, and then that will be followed by a fund update from Paul, and then finally a market update, as always, from Jeremy. If there are any questions, please feel free to type them in the question box, and we'll address them at the end of the presentation. So moving on to the next slide, the year of the bailout. Just one more. So in late April 2020, Deutsche Bank published a chart that examined historical bailouts going back to 1970. The intention was to highlight that not only was the 2020 bailout, from the international governments, the largest in history, but the scale of the bailout was larger than all the other bailouts combined over the last 50 years. As you can see, many of the bailouts barely even registered on this chart. This chart also highlights the overall G7 debt to GDP, which is the light blue line, to indicate that as debt goes higher, so does the level of bailout needed to protect the system. Analysts at Deutsche Bank added, and I quote, that even without the COVID-19 shock, the next recession would likely require multiple trillion dollars of intervention to protect the current economic system, end quote. So the concern is that the solution for today's crisis may become the cause of the next one. On the next slide, we'll look here at the post-bailout perspective from global institutional investment, the community out there. It was a survey published by Natixis Investment Managers of 500 institutional investors globally from 29 countries back in October and November 2020. Again, restating the concern that the cure for today may become the crisis for tomorrow, the survey reveals that 79% believe, again, this is the institutional managers, 79% believe the market is underestimating the long-term impact of COVID-19 on the economy. 78% believe the current market growth is unsustainable. The current valuations don't reflect company fundamentals, and low rates have distorted valuations. 95% see the potential for a market correction in at least one sector in 2021, with the top votes being the stock market, followed by real estate, technology, and cryptocurrency. And over half believe that the pandemic spending has increased the risk of a new crisis, financial crisis, and that the 2020 response will potentially limit the ability of policymakers to respond to a future crisis. 79% believe the market will favor active managers in 2021 because 65% believe equity volatility will be on the rise. And finally here, 16.7% of portfolios will be allocated to alternatives by global institutions in this year, slight increase from 2020. So on the next slide, what does all this mean then for portfolio management going forward? 2020 was an extremely unusual year from a market perspective. The S&P 500 index experienced the fastest 30% decline into bear market territory in history, according to CNBC, which then prompted the largest bailout in history by the global central banks and governments, which resulted in the fastest ever recovery from a bear market in history, according to the Wall Street Journal. In addition, this was the shortest bear market in history for the S&P 500, according to Reuters, at 33 days. Interestingly, the median age of the last 20 bear markets going back to the 1920s was almost 10 times as long as the current one at 302 days. So the question remains, are the central banks and governments capable of bailing out the markets from every bear market going forward? Remember, with each succeeding bailout, it will require more and more the next time. Some analysts are concerned, at what point does this expectation of central bank bailouts become fully priced into the markets? And what happens if the next response falls short of expectations that are really priced to perfection? This doesn't mean that the markets can't continue higher for some time. As you know, they certainly could. But are investors prepared if we were to get a repeat of 2020 with a very different market outcome? We believe that our true tactical approach, as we've discussed in previous webinars here, with the ability to shift our equity allocation between 0 and 100%, will be more relevant for investors' portfolios going forward than it's ever been. And so we will be introducing our True Tactical marketing campaign to the advisor community next month with materials to help you communicate this approach to your clients. So stay tuned for that. In the meantime, as has always been the case with our funds after a choppy period, our relative strength process is gaining momentum again and finding areas of strength, especially over the past 6 months and definitely into the first 2 weeks of this year. For more on that, I'll turn it over to Paul now for his fund update.
Thanks a lot, Jason, and thanks everybody for joining us here today. And Happy New Year! Welcome to 2021. Before I go over the final quarter and a look back on the entire year, I just wanted to mention that yes, it's definitely, as Jason mentioned, it's been a challenging year, a lot of ups and downs, literally, and actually back up again. And you know, for many people, I know through friends and family, internally, at work, it's been a tough time for some emotionally and mentally. And I hope everyone's staying safe, staying healthy, and staying happy. So with that, we'll go on to the next slide here. This is, you know, a quick summary, and we're going to actually come up with a document pretty soon, a handout for you guys to walk around with. But I just wanted to give a bit of a 2020 review on what took place over the 12 months. So as many of you remember, January and February were strong months, continuing that bull market rally we saw in 2019. For most of our portfolios, actually, I think for all of them, actually, up until about February 20th, where we just saw the peak, we saw strong gains, not just on an absolute, but on a relative basis. And then came COVID and the move down into the markets, the move down we saw into March. Obviously triggered by the pandemic, a lot of uncertainty on what might happen, and it was just a blanket sell-off across the board, just both stocks and on the fixed income side, especially on the corporate bond market, which did so well the year before. For the various SIA wealth portfolios, we took a defensive stance in mid-March, as you probably know if you've been following these calls over the year. And we went to the sidelines, a lot of uncertainty, and you know, we, based on our unemotional, rules-based approach, put us to the side. We didn't know what was going to happen, and as Jason did mention, we saw in late March and April massive intervention in the form, on a global level, really, from various central banks and governments, in the form of corporate bond purchases, for example, stimulus checks, mortgage payment deferrals. A lot was done to help everyone, interest rate reduction. So time will tell if these were overdone, not done enough, what the long-term implications may or may not be. We'll see this. But the bottom line was that, as Jason also mentioned, we saw the fastest and most dramatic rebound and rally in history. No one on this call would have seen something that quickly as far as the broad markets. And with the approach and the analysis we do, we moved back into the markets at the end of April, based on our methodology. And then from May until the end of the year, you could say it was clear sailing if you just looked at the general benchmarks that obviously did rally. From the bottom in March, it went straight up and to the right until the end of the year. But looking into the details of what was happening within the markets, we did see a lot of changes take place, and within certain portfolios of ours, a lot of turnover. The sector rotation was especially aggressive going into and after the US election, and then also with the change in sentiment with the vaccinations coming out. So you should be seeing the commentaries for the quarter end or the month end fairly soon. And Colin made a lot of comments on this. A lot of the rotation had to do with strength within the stay-at-home, work-at-home stocks, to maybe life will go back to normal at some point with the vaccinations, and various rotations based on that alone. On the next slide here, we're going to go back to that slide Jason had up here. This is, again, just for example purposes, the BMO Tactical Global Equity ETF Fund, and annotated with some of those mentioned events that we saw on the last slide. The rally at the start of the year, the sell-off where we got out of the market, where we re-entered and rallied with this portfolio with the broad markets going upward, periods of underperformance, and then a shrinkage toward the end of the year. I just want to mention or remind everyone, with all of our mandates, we're looking to add value in the long term. And long-term wealth creation is only achieved with a long-term view. And the ability to ignore short-term underperformance is crucial for that wealth creation. It would definitely be incredible and amazing, really, during every short-term period to consistently outperform. But as most of us know, that's simply impossible. And the reason I mention this is essentially because of what happened in April for most of the funds, and really in March, late March for the bond fund. These events, and I'll stress, was a short-term event, but it did have cumulative compounding effects into the rest of the year, and even looking backwards because of the effect on trailing periods. This may have caused a view from some people that we're now seeing longer term underperformance, but in fact, it is, or was in certain cases, really a short term event with which certain mandates should recover faster than others, depending on the underlying. But fortunately, SIA has historically come out of these short term periods, these underperformance periods, to the delight of most people, including myself. Really, this is a part of investing and something very specific to the way we invest. We're purposely taking risk off the table during uncertain times, and sometimes that hurts. So what was the reason for this? Well, essentially in this case, it was the move out of the markets, as I mentioned, in March and back in, be it 6 or 7 weeks later, and then fully invested back in May. This was a tactical decision based on our, again, rules-based approach. And speaking of, the word tactical, Jason mentioned that we're coming out with some stuff, some descriptions on our true tactical nature. And let's face it, the word has been used as a buzzword, for a lot of investment managers out there. And they market it as the ability to shift, right, out of various areas. And not everybody's so binary as us, where we can move from 100% equity to 100%, say, short-term fixed income or governments. But we've heard from a lot of advisors that some of these other tactical managers really didn't budge. Some of them through March, through February, didn't change a thing in their portfolio. And at the end of the year, there's no question they have a strong end of year return. But they did that taking on a massive amount of risk. They said they would avoid uncertainty, and if you didn't do anything during the month of March and April, I don't know how you could really consider yourselves a tactical investor. As Jason mentioned, certain things came into play to reverse things, but it's that what if scenario. What if the governments, what if the central banks weren't able to turn this like it did? And what if they can't do it next time? So I just wanted to mention that there are also other tactical managers out there that successfully did move out of the markets to some safety, but a lot of them failed to re-enter back into the rally because of fear going forward. So the tactical shift in one way, but not the other. So looking at the various funds we have, I'm highlighting the 3 and 6 months since they've been so strong. I think we've talked a lot about what happened, but here's the thing. Our rules-based approach allowed us to do both, to get out of the market when we saw risk and to get into the market. In late April, from our communications with advisors and investors, we had one contingent of followers back in April, or in May really at this point, that were swearing up and down that we really missed the boat. We were too late back in and we'll never be able to catch up. And then there was another group that had the similar view, but also that we were buying at a point that was suicidal. The market was overbought. It was going to head back down for a retest. Again, the rules-based approach allows us to make these decisions unemotional. And we can all see what took place next. If you look at that 6-month number, we participated in that rally where a lot of advisors or portfolios were not able to catch up. And we haven't fully caught up. At the end of the year, you can see here, 4 out of the 5 funds were positive for the year. And as I mentioned, an exceptionally strong 6-month and 3-month for the equities. As I mentioned, the current underperformance is short-term in nature. For all of our funds, nothing is broken here. what we experienced in 2020 is not long-term compounding or an issue there. It's the result of really a 1-month period. We've seen this in other mandates that we have been in existence longer than even these longer ones, and we've seen this many times before. And I understand that sometimes it's difficult to hold or stay the course, but those who did were rewarded. Jeremy can definitely attest to people, and he talks to these guys many times who did jump out at those kind of short-term underperforming times and regretted it. If this happens with all asset managers, and if you're selling out of a fund of a manager who, you know, at one point is sitting in the top decile or quartile, makes a move into the bottom half, that eventually hurts when a long-term wealth generation is taking place. Most long, and I mean very, very long-term asset managers can go through, you know, 30 to 40% periods of time where they underperform, but still over the long run succeed. So if we jump into the next slide here, this is a quick view of the BMO SIA Focus Canadian Equity Fund. First here, we'll look at the year to date. It has very similar moves that we saw with the equity fund, where we moved out, back in. The one key to long-term performance is really ultimately to look different than your benchmark. And you can see here, for instance, in the period of mid-March to the end of April, we look very different than the benchmark. And sometimes that works against you. We did move to the sideline into cash. We saw an immediate benefit right after we entered, but we're slow moving back into the markets. And that's where we look different. If we go to the next slide, here's more to that point on looking different. The next slide here is the last quarter of the year. We had very strong growth in the Canadian equities, almost making 12% for the quarter. But what I wanted to show you here is, again, a period where we look very different than the index. The active share is 94% as of December 31st. As a reminder, active share is a measure on how different we look compared to the benchmark. Now, because this is a 15 stock portfolio, we're always going to have an active share because of that. But if you look at our sector holdings, this really tells you how different than we are than the traditional energy, banking, and insurance, metals, and mining. We have a lot of exposure to the materials side, none of which are in the precious metals. Zero energy at this point, though it may change depending on the strengthening of commodities, but exposures to utilities, consumers discretionary, industrials, and real estate. For the fourth quarter, I would note that we did see a tremendous amount of turnover from certain names. After the US election took place, as I mentioned, a lot of rotation, especially out of technology into more of the consumer discretionary, and in and out of those alone. We did see some very short-term trades where we were in and out, but the system allows us to get out of the losers very quickly. What the beauty of it is holding the winners for sometimes substantial periods. Some names I'll throw out, and you'll see this in the commentary that comes out here soon, but one of our names, LSPD, up almost 91%, Lightspeed, Norbert OSB up over 80% during the holding period that we've had this year. So these are long-term or strong winners that we continue to hold. One of the sides on the metals and mining, the First Quantum, FM up over 63% since buying just in the start of November, and a very recent addition to the portfolio right at Christmas was Ballard Power, which is up. I know it's up huge again today, so we're I think we're sitting at about a 50% gain since December 24th. So this is just an example of some of the names and the ability we're able to stay and hold on to the winners. But again, for all of these portfolios this year, we did see some short-term underperformance, but that I can tell you is something we've experienced in the past and is usually short-lived. So with that, I'll pass it to Jeremy to go over some of the charts we're watching on a daily basis. Thank you.
Thanks, Paul. Thanks everyone for taking the time today. You know, some pretty interesting data coming out from Jason and Paul here. You know, looking back at that bailout in 2020, an absolute spectacular amount of resources were applied to fix that problem. It'll be quite telling in the future if that type of a response will be available, if we've got enough balance sheet at the central banks and governments to do so. Time will tell. Best we can hope for is that doesn't happen in the next few years, so they can have some time to sort that out. It was really interesting to see how fast that recovery was too. 33 days instead of the average over 300 days for bear market, really indicative of that massive response, a massive amount of capital that's gone at the market. And then Paul just showing, you know, I've been doing SIA now for this my 22nd year. And throughout the history of that, we've always had times where we've underperformed when the market's going up, or we've underperformed when the market's going down. But that intermediate and longer term trend is really important. And we can certainly see things kicking on all gears in the last quarter of 2020, and the first quarter of 2021 is a good start. Today is a great time to do a market update. We've had some changes here, but I'm going to start at the top of the list with the equity action call. We've moved to the green zone. For those of you, the last update on November 17th, we were a little bit higher than this. We actually moved up in between November 17th and today into 100% on the equity action call, and then subsequently it moved down. The move down on the AC, though, although we're still in the green, we're going to be at the highest ranking of our equity allocations, comes on the back of commodities. Commodities zipped right from the bottom of the list on November 17th, right to the top of the list as of January the 4th. So January 12th is where we're sitting today. Commodities in first place, international equity in second place, U.S. equity in third, Canadian equity in fourth. It'll be interesting to see how Canadian equity reacts to commodities on top. Traditionally, this has been beneficial for a commodity-centric economy, but we've seen a new rotation within the Canadian political system and business system, putting commodities maybe at a disadvantage from where they would have been in other cycles. Currencies, cash, and bonds. Bonds buried at the bottom is quite telling. This is really representative of the amounts, massive amounts of liquidity that's put in the system and the tremendous pressure that's had on interest rates from there. So commodities on top, but what does that look for equities? Even though we've moved, I'm just going to back up a bit here. Even though we've got commodities on top, we still see international, U.S. and Canadian equity, the next three asset classes from there. On the SIA markets, SIA chart, sorry, market equal weight index, we can see an absolute blowout breakout. So when we last represented this chart on November 17th, we were just above a double top there. So we were in that 79,000 range. We're now at 95,000. Very, very rapid growth in equities as we saw this strong run. Resistance was taken out at the 91,000 level. 91,879. This gives us room to the 112,000 level. So this is a real strong recovery. This is coming on the backs of presumably vaccinations now hitting the market. Since our November 17th, we'd heard that they're coming. We're now starting to get needles in arms, and that's a good sign for the economy, and we're seeing growth from there. But equities, even though commodities in top spot, equities remain strong going forward. So I'm going to take a look at two S&P 500 and the S&P TSX Composite as far as equity indexes. We can see the S&P 500 here. It had a triple top breakout just at our November 17th update. It just made that breakout. It's moved up a few boxes from there. So, you know, that 5-6% level. It did take out resistance at 38.20. An extremely bullish chart signal is a triple top. We'll watch that next level of resistance at 4,054, and we have room and a price objective here to that 4,400 range. So pretty strong and positive risk reward remains on S&P 500. A pullback is possible. We're a little bit, we have oversold here, but it's actually overbought here. We really got to watch that 35.29 level. That'd be the first technical sign that I'd be concerned with as far as that chart here. The S&P TSX Composite Index, as you know in these updates, Canada's really lagged the international and the U.S., at least on a benchmark basis. And to Paul's point earlier when he was talking about our active share within our Canadian mandate, which has done extremely well over the last 6 months, it's because our active share has been 94%. It's been the high levels. We've been focused on areas that are not necessarily like financials, that are at the top in the cap weighted index. But we are near a breakout here. We're at a key resistance level here below 18,121.81 on the TSX Composite, so that's good. It's really lagged. It hasn't had that breakout, so a breakout above that 18,121 level will give us our next resistance at 20,007. So the commodity strength that we just saw from November the 17th to today, this could help us. We should look at that. So I'm going to focus a lot of our talk today on commodities. So this is the chart that we measure as our equal weight index. For commodities, we can see that it has had a strong bounce off the bottoms back in March. It moved up pretty strongly out of the gate in April, May, June, July, August, slowed down a bit. It's really since November, since after that November 17th update where we've seen a tremendous escalation and movement in commodities, and we've moved from that 22,000 level right up to that 29,000 level. We're still below our trend line, so that is our big test coming up here. There is small resistance a little bit before the downtrend line, but really what I'm watching is that downtrend line to see that 32,810 level getting taken out. That would be a very, very bullish mark. We're overbought here as we were on the previous chart. So we could see a pullback from here. And really what's going through my mind is I see this commodity bull market happening. Are we seeing a new bull market for commodities? A new bull market for equities is or a stronger bull market for equities based on the commodity purchases for economic reasons? Or are we seeing some hedging here against weak currencies? Because we've certainly seen a very weak US dollar and we've seen tremendous financings coming out of central banks around the world. So that's putting some pressure, inflationary pressure, and commodities have always been a good place to hedge doing that. Copper, an absolutely explosive breakout since our update on November the 17th. It took out resistance at 335. It took out resistance at $3.62. The next resistance level is really at that highs of 2012. So we're starting to move into those levels that we have not seen for almost a decade here, $4 being an important test. We've got support above 341, so we'll watch that. Real concern would go into my mind about 328. So we'll be watching that. And copper, as I've stated many times on these webinars, is an extremely good indicator of global growth. So seeing copper rally here is great for us to see as a prediction in the vaccinations and hopefully return to normal through the spring and summer of 2021, that we're going to get that global growth and there's some pent-up demand. So we can see this showing up in commodities. We'll see if it's hedging. Crude oil still remains strong. It too has rallied up since our last. You can see that second level of support in that 44.27 range. That's where we were in November. We had broke the downtrend line at that time and looking good, but now we're seeing an escalation. We're seeing 8, 9, 10 boxes that have been added on since that time. So that's very good to see. The next test is that $60.77 level. That's an important level for us to reach. A little bit overbought here, so a move backwards, touching on that first level of support. And crude is an extremely volatile commodity, so we could even go through that. We'll just watch that second level of support. The volatility of supply seems to have resolved itself, so we're not seeing the hashing out of problems like we saw during the crisis, and global demand is increasing. So again, crude is doing very, very well. Probably the most interesting area on the commodity side, just from, I think, giving us real exposure to the interest in the economic growth side of it, is in the rare earth strategic metals fund here. So I picked up this ETF, or took a look at this ETF here, the Van Eck Vectors Rare Earth Strategic Metals ETF. And this, holds a number of rare earth metals, or those strategic metals. Really, I think this is where we are seeing some of that growth potential that's being brought in as that new economy, the electrification of vehicles. These commodities are used in alloys, they're used in batteries, and they're used in electrodes. So this is a lot of that, new economy that we're seeing there. It's been moving up extremely strong since November, moving up about 75%. So this is a tremendous growth. We're clearly grossly overbought at these levels, so a pullback would not be unexpected and could almost be expected at any point, and maybe we'll see that a little bit later as it goes higher. But an extremely strong chart, and one of the reasons why commodities has done so well with that, with copper and crude. Steel is another one that I think is important to take a look at. Again, really clearly showing that ramp up in economic activity. It's been on a tear since November as well. Signifies continued global growth expectations. Resistance here is now at 58.30, and I believe that goes back to 2011 is the last time that steel has seen those levels. So, you know, back to that that strong commodity, or at the end of the commodity bull that lasted from 2000 to, you know, the latter part of 2010. So we're starting to see those levels in commodities like steel that are there. It is, again, just as we saw with the rare earth minerals, metals, grossly overbought in the near term. So a reversal here would not be unexpected. This is our fund, so that's our update for today. But going back to commodities, that question of whether it's economic growth that is expected in this or it's hedging, my view is that it's a bit of both. There's certainly a lot of economic growth that's been priced in since our last update on November 17th, but we cannot understate the risk still available in chasing these products based on what we've seen from the debt load that's happening at governments and central banks around the world. But good news is economic growth is being forecasted here. Hopefully that continues. We had a good start to 2021. That's a very positive start. I like to watch that first 5 days, and we had a positive 5 days. So that speaks well to 2021. And we know that there's going to be continued inflows of capital coming from central banks and governments throughout the year is to be expected until we get the economy fully back on its feet again. So with that, I think we'll turn it over to questions, and I believe Jason's going to read out those questions that you've typed in.
Perfect. Just as a reminder, if you have any questions, please type them into the question box, and I'll pose them to the appropriate person. For the first question for you, Jeremy, you mentioned about commodities being the top ranked right now, and it's been a long time since you saw that on the SIA charts asset class ranking reports. Can you comment a little more on that? Just would like to hear a little more on that.
Yeah, it's been darn near a decade. So for the long-term users of SIA Wealth and SIA charts, we've been pretty bearish on commodities for a long period of time. It was 2010, November 2010 was the last time it was number one. It actually left, 2011, September 27th was the last time that it was in the number one position. So it's been, 9 years and change since we've been there. And what we see when we look back historically is right from that 2000 right up to 2011 timeframe that it comes in and out of that first place, but generally hangs around in the top four. And when it's up there, and one of the things that we'll watch closely going forward is whether Canada comes with it. I know there's that changing economy, is certainly massive investment within Canada, and certainly a lot of political pressure and social pressure to move away from our commodity-based economy, but it still remains a big part of it. It'll be interesting to see if we see Canadian equities take out US or international equities over the next little while based on the strong commodity cycle. So be interesting to see, and may reflect how important commodities are within the Canadian economy going forward. They certainly have helped. That's an area where we've had success, with our ZFC product. Our Canadian equity product has done well with that. But 2000 to 2011, it was up there almost every year, was up near the top or in the top position, and just disappeared for the last almost decade. So pretty important and telling situation to see commodities ranked number one.
Great, thank you, Jeremy. The next question for Paul. You mentioned about the performance earlier on in your slides, and just could you please discuss the outperformance of the tactical global equity versus, for example, the SI focused North American equity?
Okay. Okay. So I'll mention a couple of things. They are very different products, for one. So they're sometimes people are surprised maybe that a strategy that's entirely or majority ETFs will do less, but that zigs and zags together. So just a reminder, the global equity ETFs is comprised of sector ETFs, broad-based ETFs, as well as individual stocks, where the North American Equity Fund is entirely stocks. So there's a difference there. With the global equity fund, another thing is that we've had exposure outside of North America into Europe and Asia. So that makes it different. As far as the return difference, I think the one big thing I would note is that the North American Equity Fund had more exposure to U.S. traded stocks. So if you look at the performance for the last 6 months, it's pretty close together, around 2% differential. If you're looking at the last 3 months, it expands to 5%. And I think the majority of that difference is due to currency. Year to date, it's negligible. This will, like I said, they're very different portfolios. Sometimes they're very correlated. Sometimes they may be extremely uncorrelated, but that's probably the main reason for the last quarter differential.
Great. The next question for Paul again, this would be, can you please comment on Lightspeed? Is there a near-term top in sight, and what's the potential downside potential?
Good question. Lightspeed's been a darling, definitely within the ZFC. We also own it in the ZFN at a later date in December. Bought it in the Canadian equity in October. So that was the big jump we've seen. I think it's about 91% as of yesterday's close. As far as tops and bottoms, we definitely don't make predictions on things. All of our buy and sell criteria is based on relative strength. So if this starts to weaken off against something else, but just looking at the price action. So we probably bought this around that $40 level, maybe even less, about 35 back in October. This thing's rallied up into, it's coming up around, it ran just over $70. It's back down to 65, and it looks like it's taking another attempt here possibly to retest that recent high, which would also be recent and probably pretty good resistance. A breakthrough there, sky's the limit. That'll be a real test. On the other side, we're going to see resistance, or support levels around that $65, $64, below that around 60, and then 55. So all of those main levels, 55, 60, 65, but really none of those support levels are going to, or resistance levels are really going to influence our decision to continue holding this or to remove it. It's going to be how this does versus an alternative holding that might be coming into our peripheral as a replacement.
Next question, is the sector allocation all rules based, or does the manager, or you as the manager, have some discretion on that? Okay,
I guess that's for me again. I guess the question is more on the various sectors we own in any individual portfolio. We do have restrictions as far as overexposure, just based on the prospectus for the funds. But other than, a restriction, just for example, within the Canadian equity or even the North American fund, is we're restricted to 50% as a maximum of a GICS level 1. That makes sense to you. And then I believe about 35% for a GICS level 2. So there are some restrictions where we wouldn't own 100% technology or 100% metals and mining. So we are forced to diversify somewhat in that way, if this is the question you're asking. But we do have the ability to overweight strong sectors. But as you can see, with what we're holding in North America and Canada, we're very well diversified because we're seeing a lot of strength in a lot of different areas right now. Hope that answers your question.
Great, thank you. Next question, again for Paul. Can you address the underperformance of the BMO Tactical Global Bond Fund in 2020?
Sure. Yeah. And this has definitely been an Achilles heel for us for the year, especially. It's in line with what I was saying earlier. The underperformance we're seeing is really because of 1 month. What we saw in March with the corporate bonds, with the portfolio predominantly held at that time, saw a lot of pain, and it happened almost immediately. The other thing, other than that hit to us, had to do with currency. We were predominantly U.S. dollar based. We've made some changes in the last little while where we've shifted away from such an overweighting of U.S. dollar names more to a 50-50 between the two. And we're a bit of a crux here between whether we're going to overweight Canadian or, depending on what happens going into the new year here, go back the other way. Currency plays a big role in this. But what I would like to say about the bond fund, it is a volatile, and it is an alpha portfolio. In 2018, we saw strong returns of over 4%, considering what happened then within fixed income. In 2019, we closed in on 10%. I think we were over 10% at one point, but the year ended around 9% because of the weighting in the corporate bonds. So what we're seeing here now for 2020, a pullback of about 8%, is unfortunate, and it proves to the possible volatility that we could see here, especially when we go into the corporate markets. But overall, we're still sitting at a positive inception date return with this product. And like I said, with the other funds, we do go through these periods of short-term, and we do still consider this a short-term underperformer, even though the effects from what happened in March and some of the currency implications in the fall are still being felt on those various period returns. We're waiting to see where further strength may come in, especially with the new Biden presidency. And of course, as always, use our rules to generate the changes that may take place going forward.
Okay, another question for Paul. Lots today for Paul. Are U.S. tech stocks still in the green zone of the reports that you look at for SI managing the SI wealth funds?
Good question. I don't have any of the reports right in front of me. Technology, and you'll see this from our commentary that you should be receiving fairly soon, is how there was a lot of rotation that took place over the fourth quarter. So there is some technology, but we decreased it significantly. And as Colin has put out for some of his commentaries, this was a change from the stay-at-home sectors that really benefited. So stuff like Shopify and Amazon, stuff that really were bought up when people are staying at home, changed as soon as the vaccine talk started coming out, where we're now seeing rotation into other areas. So sorry, I don't have the report right in front of me, but it has been very volatile over the last 3 months here, or really since the U.S. election. But yeah, one quick answer. We still have a relatively high weight to tech stocks in general, whether it's through ETFs or certain individual names, sector-based or broad-based, depending on the portfolio.
Yeah, I'll just jump in here. Electronics and semiconductors remain a top-ranked sector. Computer hardware remains a top-ranked sector. Internet remains a top-ranked sector. So there are still plenty of technology names that stand out on a basis just less than it was before the fourth quarter.
Okay, great. That seems to be all for the questions for now. Again, if there's any other questions that anybody has, please feel free to reach out to us at SI Wealth. I'm more than happy to answer any questions or set up any calls for anybody who would like more information on anything you heard today. So as always, thank you to everyone for joining us today, and we'll be back in mid-February with our next monthly webinar. Take care, everyone.
Thank you, everyone. We look forward to a prosperous 2021.